tutorial number 5 for derivative trading. And so welcome everyone, and sorry I was not available last week on Saturday. And there's quite a bit I'd like to catch up on, especially regarding those practice questions. So mainly I'm going to try and go through those today. And in my experience, that's really the best way for us to learn together. It is not just a matter of, oh, here's a question, here's the answer. It is not that. In going through it and explaining to you, I think that's where we really can learn a lot together. But what I would like to do today, and also maybe on Saturday night, 48 hours later, I'd like to complete these topics, Greeks and the call spread, and I'd like to talk a bit about average and delta. I know this is where we were last time, how you average a delta, and then the practice questions. Now let me just quickly, so by way of admin, so the next lecture is tomorrow. So you know our calendar is fairly regular, and and then the next tutorial, well, from looking at it from today, the next tutorial actually is, as I said, 48 hours later, okay, on Saturday. Your assignment 1, so please try and remember that. And I know you have now formed your teams, and I thank you for doing so. Now, so the final exam will be in March. Doesn't seem that far away now. Friday, again, 6:30. Okay. This is the calendar, so it is correct. What I have done, by the way, is from this week onwards, I've actually put the corresponding YouTube. I have recorded every single tutorial so far, okay? Which is not what I normally do, but for this course, I think it is warranted. I think it is justified because the subject matter occasionally requires you to maybe go home and just in your own time, at your own convenience, try to sit down and review it and think about it. Okay, it doesn't mean you just go to sleep here. You can if you want, okay, but that would be a very poor use of your own time. If you're going to go to sleep at home, okay? Don't come. So I hope that will be helpful. So likewise, today I'm recording it. I do realize that quite often when we have a tutorial here, I say something and you don't get it. It's not because you are dumb, okay? It's because these things they take time to understand, okay? So that is why I do that here, and I don't do it elsewhere as often. Okay, so so this one, yeah. So all the YouTube are there. So I just got one. This is actually something on the side. It's the only one left I put there. Now I want to just start with some questions that I received. So thank you. Dear Sam, I cannot understand. I think this was referring to lectures 4 and 5, that double file. Oh, sorry, 5 and 6. Page 10. What are small scalps? What are large scalps? And then page 11. What is the meaning of mind the gap? And lecture 5 and 6, page 52. how to get long, short, flat for each stock price based on gamma and delta. All good, and these are good questions. And the reason I like this course a lot, it's one of my favorite courses. It's very intuitive. So when you, at the end of 12 weeks, you would realize that there actually isn't a lot you need to remember. That's why I like this. I don't like to, no, I don't want to say I don't like to remember things, but I like to derive things from first principle. Okay. I like doing that. And there are plenty of opportunities here. And I just hope that in approaching this course, which will be very useful for you guys, that you likewise try to take a very intuitive approach, and you will see what I mean in the coming weeks when we talk more and more about option pricing and hedging and so on. I very rarely use long sort of mathematical formulas or a whole load of numbers and so on. Quite often it's diagrams and pictures and ideas. That's the way I like to understand trading, because it is as much an art as a science. Okay. Now, so small scalps versus large. First of all, what does scalp mean? Actually, I'm not exactly sure myself. It sounds a bit medical. Scalpel. Okay. What is a scalp? The skin covering the head, excluding the face. Take the scalp. Okay, I think the second meaning is, so North American, resell shares or tickets at a large or quick profit. Scalping. Okay, so that's the meaning. So a scalp is a quick profit. Okay, now you go to lecture 5 and 6. So let's take a look at that. Perhaps this is a question that's on some of your minds and you just didn't realize. So we go to page 10. And in fact, I'll go one page before. Now, here you have an example of portfolio where you are long an option of some kind, and you are long gamma, and you're going to earn some gamma revenue, which is equal to a half times gamma times ds squared. Now, let me take one step back very quickly. Okay, now, and I promise that, and I want to be brief. If I am brief and you still understand, then I'm doing a good job. Okay? When you look at it in option pricing, so like I've said to you previously, except at maturity, see if I can get that thing up and running. So I showed you this last time, didn't I? When you have an option payoff, and depending on your time to maturity. So right at the end, of course, it looks like that classic, the two straight lines. One at 0 degree and the other, and the other at 45 degrees. So except at the end, you don't normally get that. You normally get a smooth curve. So I'm now just changing the time. Now everyone is okay with that, right? This is the option payoff prior to maturity. And not only that, when you move the volatility, so all else being constant, when you change the volatility, the option price can also change, but that's a different topic altogether, of course. But it is, of course, a highly relevant one. But forget about volatility for a moment. So you get some kind of a curve, okay? So if you were long a call, and it looks something like this, and let's say the spot price right now is here, okay? So I'm really just recapping before I answer those questions, okay? So let's say it is at the money, and what you can do is, if you were long the call, then you can actually hedge it in such a way. Now, if you're long the call, so like I've said to you before, you long the call, what is your delta position? You are long delta, right? And if you actually sell some stocks, you can make it into what's called a delta neutral position, because when you short stocks, that means you are short delta. So you become delta neutral, and then here is the magical thing. So when the stock price goes up, you make money on your option, but you lose money on your hedge, but your profit is a curve, but your hedge is linear because it's a straight line. So you always get to keep this bit here. And when prices go the other way, the same thing happens. So you have a loss, but your loss is a curve. So your loss will be here, but you have a gain on your hedge. So whether it goes up or down, you still make money. And there is a term for this. What do we call that? Thank you. Gamma revenue. Yeah. So when people are responding to my questions, when people are still awake, I like to give them some participation. Where is that thing? Hold on. Yeah, can you do a scan on this thing? Yeah. So that is what's called gamma revenue, and the way you calculate that is simply after you have delta hedged at this particular point, so there is a gamma position, and then you just multiply that gamma by a half by the square of the price change. Now, if there is one formula you do need to remember, it's probably this one, okay? I mean, look, it's not that hard, is it? Now, what's ds squared? ds squared is the change in the price between where it was and where it is now, okay? So either here, from here to here, if you go up, or from here to here, if you go down. Everyone is okay with that? Yeah? So I'm not telling you anything new, so I'm just reviewing this for you, okay? So this is known as gamma revenue. Now, it's a fantastic position to be in, because if you buy an option and you can delta hedge it, and it so happens this is how option traders actually trade options, okay? And I explained to you last time why they do that. Why do you buy an option and then you hedge away the delta? Why do you do that? It's because they don't really want to deal with directional market movements. option traders are there to trade the gammas and to trade the vega and to trade the theta. That already keeps them very busy. Okay, so they don't really trade the delta, not a lot anyway. So there will be some delta exposure. Okay, now anyway, so I want to tell you this first because it is relevant to the question that is raised. If you look at this page, for example, now what's going on here is that there is a price change, and actually you have to go back to the page before. Okay, so let's just say that okay, now for the second example, which corresponds to this, I think it would be okay. Let me just review this example, and then I'm going to take it one step further. Okay, now in the second example, you are so here they're short. It doesn't matter you're long or short. Either you have a profit or a loss. You just flip the sign over. So there's some guy. Has an option position where they are short 5 gammas, and the share price changed by $4. And how much do we earn or lose? Now, it's very simple. So it's just half gamma times the square of the move. So 0.5 times gamma. So they're short 5 gammas. And then the square of the move, the square of 4 is 16. Everyone is okay with that? Yeah? All right. Now, what I like you to do is imagine. Now I'm gonna develop example 2, and I'm gonna have example 2a, which is when you are long 5 gammas, okay, then your P&L is the same, except now you are making $40, correct? Instead of losing 40. All I've done is I've flipped it over. Okay. Now, example 2b is a little bit different. So the price is here, okay, and then it goes up by 2, and you have you're long 5 gammas here, okay. It goes up by 2, and then at this point you make a profit, and then you become delta neutral again. And then let's say it goes up by another $2, and then you're going to make some more money. Now, how much money do you make now? That's my question. So here, so it starts at 100, and then it ends up at 102, and here you're gonna re-hedge by making yourself delta neutral again. Now, so from here to here, the money that you make will be a half times 5 times the square of 2, which is $10, correct? So 4 to 5 is 20, yeah. Okay, and then the same thing will happen as it goes up from here to here. You're going to make another $10, aren't you? As long as you re-hedge to become delta neutral, okay? So a half times 5 times square of 2 is another $10. Now, this is when you are what we call making small scalps. So every single little price change, you rebalance your portfolio to become delta neutral. Now, I'll give you an example 2C. I'm going to come over here, okay? It's okay, all this is on video anyway, so you can go home and read it. So example 2C is, so the price goes from 100 to 102, and you don't do anything. And then you wait, and then it goes from 102 to 104, okay? Now, if you were to do that, if you choose to do that, then what happens is the gamma revenue now would be a half times gamma times the square of 4. Because in the middle, you didn't actually stop to rebalance your portfolio. You didn't re-hedge to become delta neutral. It is as if it just went straight through. So as far as you are concerned, you don't really care where it stopped, okay? Now, what is your gamma revenue here? This is going to be $40 compared to what you had in the lecture notes, which is actually $20, okay? Now, what is the lesson that we have learned here? The lesson that we have learned is if you just wait a little bit, okay, and you don't keep rebalancing and re-hedging all the time, so when the price is rising, if you don't do anything, then if it keeps going up, then for the same amount of movement, you actually end up making more money. Now, this is what we would call a large or a larger scalp. Whereas in this case, it is a smaller scalp because every $2 you want to try to rebalance. Now you might wonder, well, Sam, then why would you do the first one? Why don't you just do the second one all the time? Okay. Well, why do you think? Why is there a, okay, the choice is this. The choice is you rebalance more frequently for smaller profits, or you don't, and you just sit there and then you wait until it goes up. Sir, now, why would you not always just do the second one? Because you make more money with it, yeah. Precisely. If it goes up to 102 and then it comes back down to 100, basically you haven't got anything. Okay. If you just left the portfolio completely unhedged, it would be as if nothing actually happened to you except that little time decay. Okay. That's the point. You guys understand? Yeah. So it's always like this. It's like a game show on TV, right? So you answer some questions and then they give you prizes. Do you want the prize now, or you want to answer more questions? If you answer correctly, you get a bigger prize. If you answer wrong, you get nothing. Okay, it's a little bit like that. And so now I hope that, so that's the dilemma, okay? Do I wait thinking that it's going to go up more and make more money? In fact, it's double the money, okay, for the same amount of movement. So do I wait, potentially making more money and saving on the brokerage of trading too often? Do I do that? Or do I play safe and try and lock it in? So if I lock it in here, then even if it goes back down, well, actually, I welcome that in that case, okay? But if it goes up and down like a round trip, if you actually do a delta hedge here, you make another, you make $10 on the way up, and you make $10 on the way down. Well, good for you. But if it just goes, if you just wait then you make $40. And you trade less often also, okay? Now, you can see that this is why I like this course, and the notes actually make sense. So now they say large scalps, you want to have as wide a deviation as possible between trades. So you wait for just a bigger move before you go in and you rehedge your portfolio. So smaller scalps, you continuously rebalance to make your portfolio, to keep your portfolio delta neutral. The flip side is when there are big moves, then you find yourself trading very often and you have a lot of transaction costs. Okay. Now, and then, yes, it's Harsh, right? Hello, Harsh. If the stock goes down, you still make money. That is why I drew this diagram. It doesn't matter whether it goes this way or it goes the other way. You make money. You know, in the end, this is the way I look at it. Okay, and I don't know if you've heard anyone said this before, but this is how I think about this. In the end, I think everything about option pricing and option trading and option position management, everything about option trading is about one thing, okay? You are trying to hedge a nonlinear payoff with a linear instrument. And it is not a perfect hedge. Of course, it's not perfect. So everyone knows that. The buyer of the option knows that. The seller of the option knows that. It's not a perfect hedge. An option valuation is all about trying to identify what is that gap. And the buyer is paying that gap to the seller. That's the way I look at it. Okay? You know what I'm saying? Yeah? So that, in essence, that's what option, and all that theory on black shows and risk neutral, this and that, the concepts that I just mentioned to you, they actually all pop out in the end. I'll show you in the future. Okay? So it doesn't matter which way it goes, Harsh, to answer your question. Okay? Now, so in one situation, the decision actually is made for you. So here I am just on purpose, I'm saying, oh, it goes up $2 and then it goes up another $2. Well, things are not always so nice and simple. So sometimes the decision is already made for you. How? That is when the market opens and there is already a gap. So for example, the market closed last night at 100. So after the market closed, you can't trade. And then when you come in the morning, okay, first price is already 104. Now that can happen. There's nothing says that when it closed last night at 100, it must open at 100. No, that doesn't work like that. Okay. So in that case, the decision is already made for you. You don't have that $2 dilemma to think of if markets actually jump. Okay. Now that's what they meant by please mind the gap. If the market is just is a pun. Okay, it's a joke. So what they're saying is, if the market actually has a gap opening, okay, well, never mind. Then you don't have that choice. If you are long gamma, that's very good. If you are short, then it's not so good. Is everyone okay with that? Yeah? Why would you do that? Yeah, because you get paid for it. That's one of my disagreements. Okay. Now, what else? How to get long, short, flat for each stock price. Page 52. What was that? Ah, this one, right. Okay, I will explain that. Um, let me just go on to the next page. So I want to just summarize. So some of you are asking me. I don't want you to memorize these tables, okay? But I want you to understand them, because when you understand, you don't need to memorize. So when you are trading calls, when you buy a call, okay, we say that you are long delta. Now, long delta means when the market goes up. When the market goes up, you're happy. Okay, that's what long delta means. And long gamma, to be long gamma is a privilege. So long gamma basically means this. So you have a curve profit, but a linear loss. That's what long gamma means. Okay, so you always think of this gap here. Okay, so you are the one enjoying the gamma revenue. So if you are enjoying gamma revenue, you must be long gamma. Okay. Now, when you are long options, you are long Vega. So that means, well, when you are long something, what does it mean? It means that when that thing goes up, you're happy with it. Okay. So when you are long an option, any option, then the price now is $3. This is just a simple call at the money call, strike 100. Now, the moment volatility goes up, say from 25 to 30, which is quite a lot, so the price will change. Okay, that's what it means to be long Vega. Okay, so by definition, when you are long options, or at least vanilla options, okay, you are long Vega. So when volatility goes up, you're happy with that. Okay. Now for theta, I usually I don't talk about long short, because people often get confused and they misunderstand. But I guess if you are selling options, then you are happy when the theta goes down, because someone is paying you a premium and you want every day, day after day, you want time to go faster if possible. Okay, so when there's no theta left, you are happy with that when you are selling. Okay, so you could argue you are short. So the other one is you are long, but I prefer to talk about pay theta. Okay, because that just confuses the hell out of people. And for put options, so when you are long a put, then of course, when markets go down, you're happy. Then you must be short delta. your delta is a negative value, okay, literally. But you're still long gamma, you're long vega, you are paying, okay. Now, this table down here is just a mirror image of whatever you see up there, all right. So, like I said, try not to memorize it. Is my best piece of advice for you. Okay? Do not memorize. Try to understand. Is everyone okay with that? Yeah. Hmm. No, no. I will explain that. I will explain that at some point. Um, Theta is really just this. Okay. Now you see there is an option here, which at the moment is $3.59. Look at the call option. Okay. $3.59. Now, what is the theta? Theta is always a negative value. Theta is theta is just the change in price per unit time. And of course, that change in price is always a negative change because the price is always going down if nothing changes. Okay, so theta is always a negative value. Now, here, theta is minus 0.064. So if I just change this from 30 to 29, my prediction is that the price of the call would become 3.524. Where did I get that from? Where does that come from? Very good. Now, let's see if I'm right. It'll be extremely embarrassing if I'm not. Okay? I'm just going to blame this website. Yeah, well, it's a little bit out. Never mind. That's just a rounding error. But you know what I'm saying? And you can keep going like this. Okay? Okay, so now I have not forgotten about that question because it's coming up in the next slide when we're going to look at Greeks and call spreads. This was exactly the page. Now, what's going on here is this position has two options. You are short a call, which is October, and you are long a call, excuse me, which is December. So I assume now it's somewhere around September, or it doesn't matter. Okay, the point is you are short a call, which is shorter term, and you are long a call, which is a little bit longer term. That's all you need to know. And there are some questions that are based on this very simple idea. Okay, and we can look at the middle column to start with. Okay, to begin with. Now, so first of all, this option is at the money. We assume it's at the money because the strike is 100 and the price now is 100, the price of the underlying. So the delta of both of them, so the call for the short term and the call for the long term, will be somewhere around 50. Okay, so since you are short this one and you are long this one, so your net delta would be approximately 0. Okay, and the reason you are short gamma, okay, now, so first of all, and again, if you can't follow, don't worry, because this is all on tape, okay, so you can go home and review it. Now, if you are long one option and you are short another one, so I can guarantee you that for the long option you are long gamma, and for the short option you are short gamma. The question is how much? And a good way to possibly demonstrate that is if let's say I make an option which has got 60 days. Okay, so here is a 60-day at the money call, and you can see that the gamma is 0.033. Okay, so I'll write that down. So gamma for the 60-day is 0.033. Okay, now I'm going to go over here. I'm going to change nothing except the time to maturity to 30 days. What do you think will happen to the gamma value? Gamma will be less. Will be more. Who says it will be more? Who says it will be less? Who doesn't care? He's right. Okay, now gamma is 0.046 here. It might seem like a small number, but when you have billions of dollars, it's not small. Okay. Okay, so we were saying that you are long this option and you are short this one. So you'll be long this gamma and you're going to be short this gamma. So on a net basis, you are still short gamma. That's the reason. Okay. Now, if you want a more intuitive way to understand this, and I probably have said this last time, and again, we go back to this funny looking line when you start shifting it, and then it actually changes shape. And imagine so you have two options, and one of them is actually fairly close to maturity. And you are right at this point. Now, as you know, gamma, there's actually another word for gamma. What is that? Convexity. Okay. Now, convexity is just measuring the curvature, how curvy something is. Is my handwriting hard to read? Curvature. Okay. So obviously, this one has got far more curvature. You can just see that by looking at it, right? Especially around this area. Okay? It's like you're bending a ruler, and it's got more curvature. It's more bent, more curvature, more convexity. I'm trying to use different words to reinforce that idea. Okay? More convexity, and therefore more gamma. Okay? That is the reason why for shorter term near the money options, shorter I should say, shorter term near the money options, they have higher gamma. So that's the reason. Okay. Now it is related to this table because now I've explained to you why you are short gamma. Okay, because your short option has a higher gamma value. Well, you saw that just now, and I actually, and these numbers came from that website. Okay. Now, as for theta, you are receiving theta, okay? And what's a good way to explain this? Okay, we can also look at this. Okay, now actually, Theo, it's related to the question you just asked me just now. Okay, so so this is still the 30-day option. Now look at the theta. The theta is 0.064. Okay, now this is the, hold on, what was that? That's the 30-day theta. Okay, so for the shorter term option, this is the theta. And strictly speaking, there should always be a negative sign in front of it. Now, what about the 60-day? The 60-day. So you are short this option and you are long this one, aren't you? Yeah, you are. Okay, now for the 60-day, so I'm just going to change this to 60. Let's have a look at the theta. It's actually 0.047. What does that mean? It means, well, I can tell you two things. Okay, number one, and listen carefully, okay? The rate at which an option is losing money is not linear, first of all. In other words, you cannot take an option price, oh, $5.16 there, okay, and we got 60 days. So how much are they going to lose every day? Divide by 60. No, it doesn't work like that. It's not linear, number one, okay? That number changes, as you can see. Number two, it actually accelerates, as you can see. So here, 2 months before maturity, you are losing like around 5 cents a day. But 1 month, you are losing 6 cents a day. In fact, if you change that to, let's say, 1 week, so 7 days, you're going to lose money even faster. Now you're losing 12.5 cents a day. Okay, so the speed gradually picks up. The closer you are to maturity, the higher is theta. Okay, now at a later stage, we will tie all these crazy members of the Greek family together and see how they are related. And they are related. Okay, we'll do that later on. There is a reason why it's like that. Okay, it's not an accident. So anyway, so you are long this one. Okay, so you are long this option. So if nothing changes, every day you are basically bleeding away the time decay, right? You are losing around 0.5 cent every day. But guess what? This one because you sold this option, every day you are actually gaining time decay, aren't you? So you got to flip it the other way. And when you add it up, so this becomes a positive sign. So on a net basis, if nothing changes over time, every day you are actually gaining around 1.7 cents. Are you with me? Yeah? Now that is why here you are receiving theta. I don't like to say long theta, short theta, just confusing. You are that's good. So you are receiving theta. Receiving theta means if markets were completely frozen and time is ticking away, tick, 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 what happens to me tomorrow? Do I have money in my pocket, or do I have more money in my pocket or less money in my pocket? If I have more money in my pocket, then I am receiving theta. If I have less, I am paying theta. Okay? Now, I've only explained 3 boxes so far. Okay? What happens if you move, when you start moving down? Well, if you move down here, so now the price is going down, the stock price is going down, and you have a call spread, and it says you are delta long. Okay? Why is that? If you are wondering, if in doubt, I'm going to just wipe out all these dividends and interest rates to make it easier to understand. Okay. Now I'm pricing a trying to think what's the better way to explain this. Okay, I'm going to try and explain it by, so there are 2 options here. So you know that one is a longer term, so it probably looks like this, and the other is I'll use a different color. So the other is a shorter term. Now we started somewhere here, didn't we? And when you are here, so you're actually long this one, so you're long the call, which is longer term, and let's say so you're long the call, the longer term call, and you are short the call, which is shorter term. Now at a spot price of 100, let's just say they are both 50 delta. Okay, which is why you are delta flat, because for the option that you sold, it's actually minus 50. Okay, now when the stock price goes to 95, now first of all, the question to ask is, would the delta be bigger or smaller? Never mind the sign. Is it going to be more than 50 or less? Now I'm saying that the price moves this way from 100 to 95. For your options, would the delta be bigger than or less than 50? Because you need to at least be able to answer that question. Is the delta going to be bigger or less than 50? Very good. Yeah. And if in doubt, the dummy way, my way, right, is to say, oh look, if at this point the delta is the slope of this line, right? The moment you are here, you are gradually moving down, so the gradient becomes less and less and less. So delta has to be smaller. That's the dummy way of trying to figure it out. Okay, so the delta would be smaller. So let's say you are here. Okay, say you're here, but it is true. It's smaller because of the gamma. Okay, the gamma is positive. So let's just say the delta here is 47. Now I ask you, now you already know that for this other option, the one in blue, the delta will also be 40 something. The question is, what is that something? Is it going to be bigger than 7 or less than 7? And because of what Axel just said, you can trace it back by looking at the gammas. Now, because a short-term option actually has a higher gamma, so that means for the same price change in the stock, the delta is going to change more. Okay? Now don't forget, so you are long this one, so you are long delta here. So now you're short delta. So on a net basis, you suddenly find yourself becoming long delta, which is what this table is telling you. This box here. Okay? Now you could go to the other side, you just flip the logic, and that's how you get the short there. Now when you go to 90, the stock price 90, this is supposed to represent an extreme, so you are now fairly out of the money. Then the reason it's flat is because the delta of both options are now very, very small, maybe close to 0, okay? So 0 minus 0 is 0. Likewise, on this side, they will be both very close to 1. So plus 1 minus 1, you are also flat. Okay? So these things are interesting. Now the reason so I explained why you are short gamma here, okay? And at some point, you actually become flat in gamma and then long. Now, why is there a change like that? Now, if you study carefully, this may well be the most useful page of the entire course. Now, the graph in the middle is represents the relationship between the gammas of an option, or in fact, two options. One is a shorter term one, the other is a longer term one. So you can see when the options are what I would call near the money, near the money, okay, then the short-term gamma is actually higher than the long-term gamma. But once you get a little bit out of the money or in the money, oops, so deep out of the money or deep in the money, then they actually cross over. They cross over somewhere here, okay? So maybe approximately at the 5% point, 5% away from the money. Now this is just an approximation, okay? Now that's why they cross over like that. So this flat point, when you are flat gamma, are kind of looking at these points in the overall scheme of things. And once you cross over, what happens is that the gamma of the short-term option is rapidly losing value, whereas the gamma of the long-term option still has some value. Okay, and because you are long this one, so on a net basis, you end up being long gamma. Okay, so you can imagine if you are a trader, so you had a call spread, and your position started like this, and you are short. So when you are short gamma, you are worried that you might have to pay someone the gamma revenue when the markets are moving, very volatile. But at some point, you actually become long gamma. So that's kind of interesting. So this is something that you would want to do if you're a trader. If you think that you don't know where the market is going to end up, but you think it's going to be either going to have a huge rally or a downswing, okay, one or the other. If you think that it's going to be extreme, this is what's going to end up happening. Okay. Now, for theta, actually, you can make similar arguments. So you'll be paying theta here when the options are deep in the money or deep out of the money, because by that time, you have an option which is longer term, which you paid for, okay, and that one will be losing money. Now the other option, the shorter term one, has probably lost all of its value when it becomes out of the money. And you can see that by just looking at these two lines. So when you are down here somewhere, okay, so the other option, which is the short term one, is close to the baseline anyway. So there's no value left. So all that's left is the option where you actually paid for. Okay. It takes a long time to just explain 15 boxes in the table. Okay. But I think I've done most of that. Is everyone okay with that? Yeah. You're one step ahead of me. Thank you for those questions. They are excellent ones. Now, your first question is your gamma revenue. I don't think Govert actually called them theta revenue. It's but that's what it is, I guess. Yes. If you are long option and the market is swinging up and down, then the guy who is long is earning gamma revenue. Okay. If you sold options on the other side and markets do nothing, then the other person is earning theta. I don't know if he actually said theta revenue, but I think you get the idea. Okay? The theta, okay. We will come back to this point, but let me just say this, okay? Now, you look at an option, any option, okay, like the one that you now, okay, let's change this to 30 days. 30 days. So you get a bit of theta, okay? The theta is around just a little over 5.5 cents. It's actually 0.057. Now, what does this actually mean? There is a meaning to this number here. So remember it, 0.057. Okay, so theta okay, minus, okay. Now, this is actually the amount of money that you will lose if you hold this option and the market doesn't do anything for the next day, okay? So that is theta, or you can call it theta revenue, but I haven't heard Govert say theta revenue, so just theta. However, now, the other thing is this option also has gamma, and if the market actually, if it moves, if it does, okay, then what you're going to earn would be whatever is the gamma, and you can actually read that off, 0.046, but I won't do that, okay, multiplied by the actual movements, okay? Now, at the beginning of the day, you don't actually know what that, I mean, you can call that theta revenue if you like, okay? I don't mind, although I haven't heard Govert use the term theta revenue. Now, we don't know what's going to happen the next day. But if this option was priced correctly, these two should be the same. Now, what I mean by that is, here I'm kind of jumping ahead a little bit. So you already know what the gamma is. I mean, let's look at this. So there's a gamma value here, 0.046. So you actually can solve for what kind of market movement will make a break even. Now, what that means is if the market moves by a little bit, so the person who is long the option will make some gamma revenue. So they make gamma revenue. but the option naturally will lose some value. You can call that theta revenue, although like I said, I haven't heard Covered say that. So the gains and the losses, they should balance each other out. I don't know if that's the question on your mind. Was that what you're asking me? Kind of, yeah. We will come back to this point. We will come back to this point, okay? You can take that, okay, you can take that one step further. How do you try to figure out what this DS is? Well, you just look at the volatility parameter and you divide it by the square of 256. Or in other words, you divide it by 16. Okay? So for example, if the stock price was 100, then if the vol was 32, if the annualized vol was 32, so that means the market actually expects on a single day there will be a 2% movement, which is equal to $2. 2% of $100 is $2. Okay. Is everyone okay with that? Now, why don't we use the last 10 minutes and I will show you exactly how this thing hangs together. Okay. You can see that. Okay, so the things you need to pay attention to are three things. First of all, volatility is 32%, okay, and theta is 0.061, and gamma is 0.043. Okay, so I have actually got these numbers in a spreadsheet. Now, unfortunately, this theta is actually what we call a calendar theta. It's based on calendar days, and you need to convert that into a trading day theta. And this is something that you have to be careful with. So the trading day theta in terms of trading days, okay? So 1 year, so this is a daily theta annualized. So for one calendar day, it will lose around 6 cents. Now there are 365 days a year, so if you multiply that by 365, you redivide it by 256, you get what we call the trading day theta. Okay. Now don't worry too much about that for now, but just keep in mind you can pretend that Saturdays and Sundays don't exist. Okay, for a moment. So you have a trading day theta, which is around 0.08. Okay, and the gamma is 0.043. And now, because I already said the volatility is 2%, okay? So that means that the market is kind of expecting there will be a 2% movement in the stock price. So the stock is right now 100. So DS will be just 2% multiplied by 100, which is $2. Okay. Now I'm going to work out my gamma revenue, which is simply half times gamma times ds times ds. Can you see that the gamma revenue that I've calculated is in fact exactly the same as the trading day theta? This is in a rounding error. Okay? Now, if you can follow me, I think it's worth spending 5 minutes to. This is how the whole thing actually hangs together. Okay, your you can say your expected gamma revenue, if you really do get a 2% price movement, your expected gamma revenue will be exactly equal to the trading day theta. If you can follow me so far, ladies and gentlemen, you understand quite a bit about option trading, and when you leave this room, you are more educated than when you came in. Is everyone okay with that? If not, just go home and am I still recording? Yeah. Oh yeah. I thought I stopped. Yeah, all of that was on tape. Okay, so you can go home and just think about that. So I think I have answered these questions, all of them. And so next time, I would like to just give you a little bit of, because we've been talking about average delta, and isn't it? It's so neat and tidy. You have an old delta and a new delta. You add them together. You take the average, and then you calculate the price. Wow, that sounds too good to be true. There is a theoretical foundation to it, and we'll go through that next time. Okay. And I was hoping we'll look at these questions. I haven't done that. But don't worry, we will. All right. So, maybe there is something else I can show you. Let's try this one. This is how the Greeks actually behave. Now, this is the sensitivity of a call delta. How the call delta changes. I assume its strike is 100, and this is the underlying price, going deep in the money or deep out of the money. But you can actually change these parameters. So like I said to you, when you have a call option, if you're long the call and it's a long time before maturity, your delta doesn't really change all that much. It changes slowly, but when you are very close to maturity, either nothing happens, when it happens very fast. Okay? And that's related to the pin risk that we were discussing last time. Okay, and likewise, so the gamma is far more dramatic for shorter maturity, and when it's longer maturity, okay, it's reasonably smooth. But when you get very close and you are at the money, gamma actually can become infinite. Okay. Does anyone use Does anyone know where this came from? Would you like to go home and play around with this yourself? It's from Wolfram. It's called a CDF player. This stands for Computable Document Format. Do you know Wolfram? Yeah? Who's heard of, apart from Excel? Who knows what Wolfram is? Very good. Actually, Stephen Wolfram is a very, very clever guy who invented Mathematica, which is a software for a lot of mathematical computation. And if you go to his website, you can actually download this and you can play around. I think it's better you go home and you download it and you play around with it. They might ask for your email address. It's okay. I don't think they try to sell you anything. Okay? He's actually written some pretty interesting books. If you are curious, they're worth reading. I got one of them. It's not about mathematics. It's a book about a lot of interesting people that he's met in his lifetime. Personal perspectives on the lives and ideas of some notable people. Very interesting book. Don't read it now, but I recommend that in the future. Okay. So I hope that was helpful. But we must get on to these questions next time. So we'll see each other on tomorrow and then on Saturday then. All right. Thank you, everyone. Have you all signed in? Everyone has signed in? Already qualified with two. And also and Faye as well.